All right, let's get started. So, good evening, everyone. Welcome to the first installment of Mastering Your Finances webinar series. So, we have done this series a few times and we have gotten feedback from the viewers. So, here we are again. Good feedback, of course. This time, we'll be diving a little deeper and we're going beyond the personal finance and investing basics that we have shared in the past. Now, in the next few Master Your Finance webinars, I'll be sharing more about how you can build your ideal portfolio. Next week, we'll talk a little bit more about income assets. And the week after, we'll actually dive deeper into ETFs. Now, for the last one on the 29th of this month, 29th of October, we're actually doing something a little bit different. I'll be speaking to Dinesh, who's one of the co-founders of Dollar and Cents, and we'll be speaking more about his entrepreneurial journey and his own personal finance journey. So if you would actually want to sign up to be part of these webinars, my colleagues will actually share a link in the chat. So we're live both on Zoom as well as YouTube. So thank you and welcome everyone. And I would highly encourage everyone here to sign up and join us for the other 3 sessions. By the end of it, we definitely want to ensure that everyone is prepared and well on their way toward building sustainable wealth for the long term, as well as make sound finance decisions. Now, once again, thank you so much for joining me tonight. I'm currently the head of client experience at Stashaway. It's really nice to meet everyone here. We're here today to learn more about the steps one can actually take to protect and grow their wealth. And if you're someone who has not started investing, I hope that by the end of tonight, you'd actually be confident enough to take the first step toward realizing your financial goals. Now, before we actually move to the main event, this is just a short introduction of Stashaway for those who actually may not know who we are. We are a wealth management platform, and we started in Singapore, and we were actually the first digital wealth platform in this part of the world back when it was still called Robo Advisors. Since then, we have expanded into 4 other geographies. This includes Malaysia, the UAE, Hong Kong, as well as Thailand. We are licensed in these 5 jurisdictions, and we're backed by some of the biggest investors in the world. This includes Sequoia, Fidelity, as well as Hamilton Lane. We've also collected multiple accolades over the years, with the most recent being named one of the high growth companies in Asia Pacific by Financial Times, as well as being one of CNBC's top 200 global fintech companies. Now, over the years, we have also launched multiple products across our platforms for our users. Here, what you see on your screen is actually a high-level overview of what's offered today in Singapore. Again, after today, you will take the first step to explore and deposit your first $10 or $100 into one of these. I'm very sure of it. But of course, if you feel like if you need more help understanding our products or really just figuring out which products are more suited for which goals, feel free to reach out to our team at support@stashaway.com. Once again, that is support@stashaway.com. We're also available on WhatsApp. If that's your preferred mode of communication, you can also dial into one of our landlines. As a reminder, we are live both on Zoom as well as YouTube. So if you have any questions at all throughout the night on Zoom, please feel free to use the Q&A function button. It's actually hidden, if I'm not mistaken. If it's not on your screen, if you don't see it on your screen, there is a button there with 3 dots that says more. If you click on it, that's where the Q&A function button is hidden. If you're on YouTube, please feel free to just use chat. My colleague actually is in the background helping me to moderate the questions. If there are any sort of questions that needs to be answered, I will be answering them toward the end of the webinar. Now, this is just a general overview of how our app actually looks. So as you can see, we've made this UX super easy for everyone. But again, if you need help, we are available at support@stashaway.com. Now, moving to the main meat of tonight, this is the agenda for the evening. So we'll be going through 4 different parts, with the first being a little introduction into investing as well as diversification. Then we'll run through building a portfolio and why taking into account the various economic cycles are important. Lastly, we'll also talk about why diversification in general is important. Now, I do want to make this as interactive as possible, so I will ask for some participation from the audience. I hope that you will actually interact with me. Obviously, again, the Q&A function button is available. Now, just to get started, we'll be starting a little bit more about investing and diversification. Now, before I dive into the main meat of the content today, I just kind of want to get a sense of where everyone is at this point in time. So, if you're on YouTube, please feel free to use the YouTube chat function. Here on Zoom, please feel free to use the webinar chat function. But as an example, if I were to give you $10,000 today, how confident would you be in deciding where to invest? Do you feel like you're at 1 where you probably need help? Or do you feel that you're at 10, telling Warren Buffett to sort of stay in his lane. So let's kind of see where the audience is at. So again, on Zoom, please feel free to use the webinar chat. If you're on YouTube, please feel free to use the YouTube chat function. All right, so we're seeing a lot of fives, actually. Some ones. We have an 8. Well done to you. 6.68. I like it. Very precise. 1, 5. Okay. So it's actually really nice to see that we have a very, very mixed group here. And that's actually really, really cool. And for those who are already at close to 10, thank you so much for joining us. I hope today, if anything, you would have leveled up slightly in terms of your knowledge of investing. For those at 1, I hope by the end of the day we will get you at least somewhere closer to 5, and those at 5, I hope we'll get you somewhere closer to 10. It's all about the baby steps, right? Okay, thank you so much for this. It's actually really, really insightful, and it's good for us to also know our audience a lot better. Now, next question actually. So this is where I would need everyone to use your phones. So right here, what you see is a QR code that will actually take you to a Slido link. I just want you to, off the top of your head, right? 2 questions here. If you're at a 1 and you have not started investing, why are you not invested today? If you're already, between 5 to 10 as an example, and you're already investing, what is actually stopping you from investing more, right? If maybe you've had certain investments and you've decided to stop, it's actually short form answers, and it's actually a word bubble, which I'll share on the screen. I'll just leave this QR here for a little while people actually scan it. We actually like to really also understand, what is really keeping people from either investing more, number 1, or perhaps even start investing. So just checking that everyone can actually see this. Okay, some people would like the link. I've shared a link in the chat. Can you just let me know if you can actually access the link? All right, so we're seeing a few answers coming in. Too many choices and not enough guarantee. Okay. Too many platforms and picking one is difficult. Fair. Uncertain, fear, risk in the market, not enough cash, not sure how to invest, lack of capital. So it's actually really interesting because we are seeing a lot of very, very different, oh, sorry, can't see my link. Apologies. Here. Let's see if that works. Okay, insufficient fund, insufficient knowledge, clueless, fear, still investing. Okay, great. Not enough funds, not enough cash, lack of understanding. Okay, so we're actually seeing, as probably everyone can also see on the screen, very, very different reasons. And it's also very interesting to see that it's also on different ends of the spectrum, right? You have individuals who are very fearless, they feel clueless, they are probably risk averse. Market crashes, doomsday scenario, sure. Lack of understanding, not sure how to invest, which is hopefully we can see. Hopefully by the end of today, we'll be able to actually help everyone start that journey. For those that have lack of capital, I think there is a little bit of a misunderstanding that you need a lot of money to make a lot of money, or you basically need a lot of money to start. I think for a lot of us, some of the biggest hurdle is really just starting. But if you think that there's a lack of capital because, say on a monthly basis, you can't set up recurring deposits as an example. Honestly, even putting aside like 10, 20, $50, whatever you can is beneficial for you and your long-term investing goals, right? So I'll run into this. I will share more about, basically all we have today in our slides. I hope we'll be able to address some of these concerns that some of you have. But on that note, let us go back to the presentation. Once again, thank you everyone for participating. So just checking that we can see my slides now before I move on. Okay, so let's move on to investing. What is investing? So the idea of investing itself is already intimidating for some, right? As you can see just now in the word bubble, there were some people who put fear, some people who put clueless. And if you were literally, to sit down today and try to Google and try to understand what it is, you will be hit by extremely verbose sentences with big words, which just adds on layers and layers of complexity and essentially also create a bigger blocker for a lot of us to start. Now, personal finance in general is full of concepts that intimidates newcomers. In reality, being smart with money does not require you to be a genius. And a lot of complex sounding financial principles, terms, definitions are actually pretty simple. People just like to use big words around these sort of things. Now, what is actually investing? Investing is simply allocating resources, which is usually money, with the expectation of generating income or profit over time. Now, before we actually start investing, let's start with understanding the various asset classes. Now, corporate and government bonds are generally less risky and suitable for individuals who are less comfortable with taking on any sort of higher risk investments. Now, if we break it down, bonds are actually debt securities that are issued either by corporates or governments, and in the case of government bonds, to raise capital. Now, when you invest in a bond, you are a government in the case of government, sorry, and these debt securities are issued by these entities or governments to raise some form of funds, right? Now, when you invest in a bond, you are essentially lending money to the issuer, either a corporate or a government, in exchange for a periodic interest payment and the return of the bond's face value or principal at a specified future date, which is commonly known as the maturity date. Now, bond yields are influenced by several factors. This obviously includes interest rates, credit risk, the risk, which is the risk of default by the issuer. This usually is tied to corporate bonds, time to maturity, as well as market conditions. Now, when interest rates rise, bond prices tend to fall, leading to an increase in yields and vice versa. Now, commodities can be a valuable addition to a diversified portfolio as well. Now, certain commodities like gold and silver, they have a history of serving as hedges against inflation. So when the value of currencies decline due to inflation, the prices of these precious metals, they often rise. And then this helps preserve some sort of purchasing power. So during times of economic turmoil, any sort of market instability, commodities usually act as a safe haven. Now, investors often buy commodities like gold and oil as a store of value when the other assets are under pressure. So now there are different ways to get exposure to commodities. You can gain exposure to ETFs, physical commodities like silver or gold bars, and perhaps through futures contracts, which allows an individual to speculate on price movements of the commodity. Now, certain commodities like gold are viewed as a safe haven and is of relatively lower interest as an investment. The way you choose to gain exposure to these commodities really depends on your risk profile. So as an example, buying a physical gold bar or an ETF that tracks gold prices is much lower in risk compared to buying gold futures, right? So there are very, very different ways you can actually get exposure and different varying degrees of risk depending on how you choose to get exposure to these commodities. Now, real estate. It's two kinds. You have the physical and then you have real estate investment trusts. They are related but very distinct ways to invest in the real estate market. Now, when you invest in real estate directly, meaning a physical real estate, you are purchasing physical properties such as residential homes, at the same time, maybe apartment buildings, commercial buildings, or land. So you become an owner of these properties and your return on investment typically comes from either rental income or any sort of property appreciation. Now, REITs, which is short for Real Estate Investment Trusts, are basically investment vehicles that pool capital from multiple investors to purchase and manage, income-producing real estate properties. Now, they operate similar to mutual funds, but focus on real estate assets. Now, REITs can invest in various types of properties. So this includes office buildings. Now, in Singapore, one of the biggest ones is probably CapitaLand. Mapletree is also another big one. Shopping centers, apartments, and more. Now, physical real estate investments are less liquid, and you obviously require a substantial capital upfront. And if you wake up today and you decide to sell it tomorrow, it's not guaranteed you even make your money back. So it's obviously also less liquid. While REITs definitely offer easier access to cash through the sale of shares. Now, these REITs are usually traded on stock exchanges. So that means you can invest in REITs with a smaller initial amount. And at the same time, if you choose to sell it today because you've made enough cash or you do actually require the cash, you can actually do that by just logging into your brokerage account and actually selling this REIT. Lastly, we have equities or stocks as it's popularly known. Now, when you own equities, you basically own a portion of the company's ownership. And essentially, you are what we call a shareholder. So they offer the potential for wealth accumulation over time, but it also does come with risk. So depending on the sector or the company that you decide to invest in, the risk you will be exposing yourself to varies. So you can, however, get a more diversified and lower risk exposure via exchange traded funds, or ETFs for short. And we will actually dive into ETFs a little more in our third webinar. So actually do sign up to learn more in the upcoming weeks. Now, as I mentioned, different assets presents different risks. So what you see here is the scale of the asset and the risk in which you are taking on. The asset toward the right being assets of higher risk. And the reason these assets are higher in risk is because of the risk premium that you are taking on. Now, as an example, right, if you see on the far left, there's cash. Practically zero risk because it's not invested. You have it with you all the time. For corporate bonds, it's safe, but it's still riskier compared to some of the other assets because you're taking on additional risk. If interest rate changes, as an example, if the credit rating of a specific corporate changes, this all affects the bond, which then potentially affects your returns. And then to the far right, you have smaller cap stocks, which is the highest risk based on these four core factors, among other things. So obviously liquidity premium, small caps, sometimes they're not as vastly traded as blue chips. So you're also taking on that liquidity risk. Now, of course, high risk does also equal higher returns, but it also means a potential for larger swing downwards during market downturns. Now, I know it's very easy for us to get extremely attracted by the potential upswings, but the swings down are also extremely important. We should never ignore that, right? We need to be prepared for that. So if this is something you do not feel comfortable with, then perhaps you are actually invested in something that is too high risk for yourself. So please do keep this in mind. But of course, when building a portfolio, you should not just have one asset, meaning you should not just put all your eggs in one basket, right? We've always heard that. You should diversify. Now, why diversify? There are basically three main reasons, right? So the first up is risk reduction. Now, diversification definitely helps to mitigate the impact of individual investment losses on your overall portfolio. So essentially, when you spread your investments across different assets, the poor performance of one asset may be offset by the positive performance of the others. So this then essentially reduces the risk of a significant loss, right? So it kind of balances out the risk a little bit more. So in short, diversification basically lowers the overall volatility of your portfolio. Now, when you hold a mix of assets of different risk profiles, the portfolio's value is less likely to experience extremes up and down because of the balancing factor of the various assets. And basically, you are also less likely to panic or make any sort of impulsive decisions during any sort of market downturns. This can make it easier for you to actually stay invested. It makes it less emotional during any sort of market turbulence, right? Now, with a reduction of risk, this also means that your portfolio will experience steadier returns. As I mentioned, when you diversify, your assets sort of balance each other out. So volatility is obviously unavoidable. There's no such thing as zero risk. The only thing that a lot of asset managers can do for you, and just remember this, is they can minimize risk, but they cannot completely they cannot completely erase risk from your portfolio, right? So just remember that we can only minimize risk. We cannot completely eliminate risk. A diversified portfolio is likely to exhibit more stable and consistent returns over time. Now, as I had just mentioned, while some assets do experience fluctuations or underperformance, and others may actually perform well. So this actually smoothing effect can provide a more predictable investment experience. In the longer term, this helps with preservation of your capital. How? So let's just assume a portion of your portfolio suffers losses. The gains in other areas can then help to offset these losses, and this prevents a significant erosion of your initial investment. Now, through this diversification, you're also able to gain a much broader exposure with diversification. Now, this is not just across asset, right? But it's also across industries, geographies, which I will actually talk through a little bit more later on. And spoiler alert, if you actually do it all via ETFs, you will actually be doing it at a significantly lower cost. Now, over here is a really, really important chart. Loads of colors, a lot of text, but the main context is really to show you the performance of the various asset classes over the years. Let's take something a little bit more recent. Let's look at 2020, right, as an example. Now, if you see at the top in blue, small cap stocks actually performed the best that year. So they had an estimated return of about like 20%. And the REIT market, which is at the bottom in red, was actually the worst performer at negative 5.1%. But then what happened in 2021 was that REIT market actually was suddenly up. It was actually the best performance, averaging about 41.3% returns. And cash, which was the second worst performer in 2020, was the best performer in 2022 when everything else was down. So now this just kind of goes to show you that it's extremely important to remain diversified, and having everything in one asset is not the ideal way to invest. Now, let's very quickly run through what a diversified portfolio actually looks like. So this is an actual statutory portfolio, right? One of our lower risk ones. As you can see, we give you exposure to all different kinds of asset classes. And obviously, because it's of lower risk, there is a larger exposure to lower risk assets like bonds. But even within bonds, it's extremely diversified. So we have various government bonds, corporate bonds, as well as aggregate bonds. So if you see here on this, yeah, so you can even see within bonds, it's extremely diversified. Next is actually one of our higher risk portfolios, which then obviously has a larger exposure to higher risk assets, which is equities in this instance, and which is also within that same segment, extremely diversified. So if you see here, you have exposure to India, you have exposure to Japan, you have exposure to sectors like healthcare, tech, industrials. So where I'm going with this is that it's extremely important that you build a diversified portfolio. And this is important so that you can manage your risk. And it's also important so that you get a broader exposure. And more importantly, it's so that you can ensure that your portfolio has steady returns versus experiencing any sort of large swings when the market moves. Now, sorry, water break. So I've talked a lot about diversification, but what is the best way to actually build a diversified portfolio? Now, this is a concept that we wholeheartedly abide by and believe in, and that's the concept of asset allocation. Now, what does this actually mean? So this means you are essentially dividing your money or the funds that you have prepared to invest into different assets to achieve your financial goals depending on your risk tolerance. Now, there are two main kinds of asset allocation strategies, right? And this is what you see on your screen. There's the strategic asset allocation model, and then there's the tactical asset allocation model. Now, strategic is more of a hands-off approach. So you identify certain assets, you have a really strong conviction, meaning you believe wholeheartedly in this particular asset, and you buy and hold it for the longer term. You perhaps set up a recurring deposit into it every month. You decide you want to invest a certain amount of money, and you choose to not look at it even through all the ups and downs. Now, tactical is more active in nature. It's more like trading. So you take into account what the market looks like on a daily basis. And this is usually for people who have more investing experience. A diversified portfolio, as you see in the middle of this little Venn diagram, would ideally have a mix of both assets. And there is absolutely nothing wrong with just wanting a strategic asset allocation strategy. To be honest, I'm someone who's more on the strategic asset allocation part. I invest for the long term. I don't trade. And I try to make sure that I don't buy into speculative assets. Now, when you do asset allocation, there is also a concept of rebalancing. Now, what does rebalancing actually mean? So it's the act of adjusting the proportions of different assets when they drift from their target percentages, right? So this often involves selling some of the assets that have grown in value and buying more of those that have underperformed. So let me kind of give you a little example, right? So say you buy 5 different assets, and you had initially decided that it will be a 20% exposure to each of them, right? So you have $1,000, you have 5 assets you want to buy, you decide it's going to be 20% exposure. So each asset, you're going to basically park $200 each, right? Over the course of markets moving, a couple of weeks, couple of months, one asset actually goes up significantly. And with the price increase, the value of this is now 40% of your total portfolio, right? Just because of the price increase. And say, as an example, there are 2 other assets that have not performed as well, and they're now below the 20% target exposure that you had actually set for each. Now, in an ideal world, what you would do is you would take some profit for asset A that had gone up significantly to bring that 40% exposure back down to 20%. And then with whatever, I guess, profit that you had made from selling asset A, you then use that profit to buy more of assets B and C to bring their allocation back up to 20%. So why do we do this, right? First, it helps you to maintain your desired asset allocation. And then obviously with your desired asset allocation, you will then be within the comfortable risk level for yourself, because there is a reason why you had decided certain target allocations, right? Because that's the risk comfort that you're comfortable with. And lastly, more importantly, is actually one of the core ways for us to maintain a really disciplined approach toward investing. And also, honestly, it helps because this is very, very in line with what everyone says, which is to buy low and sell high. So that's why rebalancing is extremely important. Now, the concept of steady returns doesn't mean you don't perform well. I think that's where people sort of kind of gets a little bit confused. or where people get confused, because when you say like, oh, you're stating out the returns of my equities, for example, this is the year when equities go up, my bonds is gonna basically completely eat into my returns. That's not exactly true. These are actually three different risk portfolios that we have at Stashaway, right? So you can see it splits between SRI 16, 22, and 36. Now, SRI is actually, just very quickly, SRI is actually our statutory risk index. What this essentially means is that in a given year, there's only a 1% chance of you losing a specific amount of money. So as an example, for SRI 16%, this means that in a given year, there is only a 1% chance that for every 1,000 that's invested, you may lose more than $160. So there's only a 1% chance, right? 99% of the time, we obviously try to keep it within this parameter, but obviously market moves up and down. So there's no way we can completely eliminate risk. But that's why the rebalancing actually comes into play, because then it helps you sort of keep the risk within that parameter that you're comfortable in. So for SRI 16%, that means, in every given year, 1% chance of that for every 1,000, you may lose more than $160. So there's only a 1% chance. 22% is 220 and 36% is 360. And obviously SRI 36% is the higher risk of the two, right? Of the three, sorry. On the bottom, you see the performance. But for the last year and year to date today, we're already 3/4 of the year in, and we're already very close to touching last year's returns. So I dare say that we're actually on track to beating last year's performance. But my main point is that having a diversified portfolio doesn't mean that your returns will be boring. There is still potential for your portfolio to return. Now, going back to basics a little bit, before you start investing, there are 4 key factors for you to consider. First things first, your financial goal. What are you saving for? What is your target amount? That's actually very important, right? Second thing is your time horizon. How much time do you have between now and when you actually, have decided that your goal is meant to happen? The third thing is obviously your current financial situation. What is your current circumstance? How much are you actually able to set aside toward this goal? How much can you set aside on a monthly basis toward this specific goal, leading up to when your goal is actually due? And the fourth, and obviously one of the more important ones in my opinion, is actually your risk tolerance. So how much risk are you comfortable taking? Now, I do want to deviate slightly to talk a little bit about risk appetite and risk tolerance. Now, these two things are actually quite different, but they often get confused by a lot of people. Now, risk appetite is when someone is saying, I'm willing to invest in risky assets. Now, keyword here is willing. Risk tolerance is I can't accept risk that will cause my portfolio to decline more than 10%. Now, tolerance is more important than willingness when it comes to risk taking, right? People generally will say that they are willing to take higher risk for the promise of higher returns. But when the market actually moves against their expectations, they find that they are unable to sleep well at night. So do make sure that you are taking risks that is within your comfort level. Now, I spoke about time horizon as a factor that's important, right? And this is why. So here you see on your screen, here you see on your screen 2 different assets. They are of 2 different risks, bonds or equities. Now, bonds, which is the lighter blue line, as you can see, it's less volatile. It's still volatile, but it's less volatile compared to the darker line, which is equities. And the returns in general over the longer term is probably not as attractive as the darker line, which is equities. But what happens when you put golds in the mix, right? So as an example, you see here, you have gold A and gold B both starting at the same time. Gold A ends a little bit earlier, gold B ends later. So 24 years from when you actually started golds A and B, that's when gold B ends. If you had decided to invest in equities for your shorter term goal, goal A, upon when you needed your funds, you would have had to withdraw less than when you have started, and you may actually not have enough for the commitment that you had made for that specific goal. Whereas if your goal is longer, like where goal B had ended, you can afford to invest in higher risk assets, and you would have essentially more time to go through the market movements, right? Now, this is why your time horizon also plays an important role when deciding on the level of risk that you should take when investing. But if you were to say to me, oh, May, even though I have such a long goal, like the markets are so volatile, like should I even bother? I think it's very important for us to really remember that yes, on a daily basis, markets are actually pretty volatile. We do see swings on a daily basis. If you were to check your own investment portfolio today, tomorrow, the day after, next week, you would actually be hit with different returns and different numbers. But the reality is when you zoom out, in the long term, markets always trend upwards. That's why it's so important for you to understand what your goals are, what the time horizon of your specific goals are, and what risks and the risk capacity that you can take. So as an example, if you're someone who's willing to, who can tolerate a little bit more risk, but perhaps the risk that you can tolerate is still lower than if you were to go full on equities, then perhaps think about investing in more defensive equities, right? As an example, perhaps something like consumer staples like healthcare. Consumer staples, yes. If you're someone who's willing to take more risk, then within equities, there's also the high risk category. So you have anything from emerging markets, as an example, right? Or even tech. Tech is relatively high risk. So there are also different ways that you can get exposure within a specific asset class. At the same time, I just want to reiterate that yes, every day markets will look very different, and every day market will be very volatile, as you can see. If you were to compare the chart, from September till today, the last, let's call it 5 weeks, markets were extremely volatile. But in the next 10, 15, 20 years, this small period is just it's really a blip, because in the long term, when you zoom out, markets always trend outwards. I think a couple of years back, people were saying S&P 500 was an all-time high. Today, S&P 500 is at a new all-time high, right? So who's to say that another all-time high will not happen in the next 10, 15 years? So I think that's actually very important to keep in mind, especially when you want to do or when you want to embark on your long-term investment strategy. Now let's dive a little deeper to talk about the different roles of assets. First, we have bonds. Now, bonds, first of all, they are lower risk, so they generally provide income and stability to a portfolio. They do act as a counterbalance to other riskier assets. And due to this, they do reduce the overall portfolio volatility, right? And they do also offer capital preservation, because in addition to paying regular coupon or interest, upon maturity, bonds are also meant to repay back your capital. Let's look at equities stocks. There are usually three main types. So we have the large cap, mid cap, as well as small cap. Now, large caps are usually established companies. So we're talking about the Apples, the TSMCs, the blue chips of the world. So they are generally more stable through any sort of economic cycles, but growth can be slower. So if you're someone with a lower risk tolerance, this would probably be ideal for you. Mid-caps are companies in their growth phase. So not large yet. IBKR is probably a good example. In Singapore, we have Thomson Medical, Oxley, and they are more volatile than blue chips, but they do have some potential for growth in them. So if you do have a higher risk tolerance, then you can perhaps consider investing in these mid-cap companies. Lastly, we have small caps. Now, these are younger companies that have just listed. Perhaps they also have low liquidity because not everyone actually knows much about them or has the capacity to perhaps invest in them because of how risky they are. So this actually means that they have high growth potential, but they also have very high risk compared to the other two. Now, if you have the capacity and can tolerate the risk, then you can obviously consider having this exposure for yourself. Now let's break it down further into markets. So we have two different markets that everyone always talks about, right? So you have the emerging or the developed markets. So what do these two terms actually mean, right? So developed markets are basically established economies. So we're talking about the US, America, Europe, Japan, even Singapore. Emerging markets are the rapidly growing ones. So we have Malaysia, we have China, we have India, Brazil, we have Thailand, and allocating assets to these will really depend on your risk tolerance. Generally, emerging markets have higher growth potential, but they are also higher in risk. So do bear that in mind. Very quickly, I would like to run through the concept of core and satellite portfolios. Now, core portfolios are the ones that you have that are passively managed. So they usually contain safer assets like ETFs, and the assets within your core portfolios are generally lower in risk as it's really for long-term investing, right? Now, satellites are the ones that are more actively managed. Now, this could be anything that's thematics, could be your alternative investing, digital assets, right? And these things are generally higher in risk. Here's a little guideline. And as I mentioned before, diversification is extremely important. So you can have both a core and satellite portfolio and have a healthy split to ensure that your returns remain steady. The general, I guess, advice allocation for a core portfolio should be 70 or 80%. And the satellite is usually 20 to 30%. But I do want to share, it's very, very important that you actually make sure that you're actually comfortable with this. As an example, as I mentioned, if you're someone who's more comfortable or lower risk, you can have 100% core exposure, because that's generally something that's, for longer term investing. If you're new, it's absolutely fine to start out with just core portfolios at this point in time. The mix and match really depends. There's no one size fits all. It's really a one size fits one. Everyone's risk tolerance is different. Everyone's circumstance is different. Everyone's capacity is different. So the allocation toward the core and satellite really depends on your individual circumstance. If anyone has any sort of questions or has a very unique circumstance to themselves and they would like to basically learn more, please do feel free to reach out to support@stashaway.com. Our engagement team is actually on hand to help you through the thought process. It is very hard to answer general questions about all these things because obviously it really depends on your individual circumstance. So unless we actually know more about your financial situation and capacity, it's really hard to really give you a really straight answer. But generally what you see on screen is the general guideline toward building a core and satellite portfolio for yourself. Now, we're almost at the end. We're at the second last. I hope everyone is still with me. Again, if you're watching on YouTube, please feel free to use the chat function to ask questions. If you're on Zoom, please feel free to use the Q&A function button. My colleagues are actually helping me with answering the questions because we do actually want to run through as much questions as possible. Any other questions, I will actually get to them toward the end of the webinar. Now, let's talk a little bit more about economic cycles. This is actually a really good graph that actually represents the cycles. Now, we usually either go through an expansion or a contraction phase, and market sort of moves in this wave, depending on where we're at, right? So when in expansion, companies and economy is generally doing well, so markets will trend up. But if it then hits a peak and then it comes down. Now, this is when growth kind of slows a little, and this is when we're in what we call a contraction. Then we hit a trough, and then market kind of goes back again. The spending returns, consumers go back out to shop, economy expands again, and then we hit higher highs. And then essentially it comes to a point where market is a little bit exhausted. That's the term people like to use. Market's a little bit exhausted, and then we come down again, right? It hits a new peak and then it comes down again. Timeline for this, no one can really predict. Assets also do perform differently depending on the cycle. So as an example, in recession, equities tend to be poor performers while bonds actually perform better because obviously people would kind of move a little bit into low risk assets. In good times, when spending is high, people are happy, people feel like spending money, economy is doing great, then equities or stocks tend to be the superior performer, while bonds actually perform slightly poorer. Now, why is it important for us to be aware of the cycles, and how does this help actually with long-term investing, right? Now, first things first, it helps with us making good decisions. So when you understand, or when you're aware, let's call it aware of the economic cycles, you can actually decide what kind of investment will be appropriate for specific timelines, right? The second thing is in terms of managing your expectations or emotions. Again, when you're aware that it's a cycle, you will actually be able to stay a lot calmer during any sort of volatility. The third thing is obviously it helps you identify any sort of opportunities. Different sectors and assets perform differently in different cycles, right? So you can actually align your own strategy to suit this. The fourth thing is managing risks. So understanding the cycles also allows you to sort of manage your portfolio. The last thing is that it also helps with long-term perspective. So you can actually maintain a much longer term view, taking the element of emotions out of investing, which is the most important thing, right? Because I think a lot of times people miss out on opportunities, or people actually exit prematurely from a specific investment because of emotions. So actually understanding economic cycles and why assets are performing at a certain time period is pretty important for you to be able to make sound decisions. Okay, so lastly, let's talk a little bit about navigating cycles with diversification. So I'm going to use Stashaway actually as an example for various reasons, but one of the main reason is really, I honestly think that we do it best, in my opinion. And it's something that, I think a lot of people also have questions about how we actually do it. So I think this will be a really good explainer to how ERA actually works, right? So for those who don't know, we have an algorithm actually running in the background. It's our proprietary algorithm, and it's called ERA for short, or for long. It's really economic regime asset allocation. So what it does is that it actually takes data, forward-looking data, and then helps us sort of calculate what the economy looks like in the next 6, 12, 18 months. Are we going into a recession? Does it look like it's an inflationary environment? Do some assets look too expensive? Does it look like some assets are undervalued? So as an example, in December 2022, you can see the little movement there. ERA actually told us that we were in a stagflationary environment. So what does that mean? That essentially means that growth is low. People are not spending that much money. People are saving money, cash people are risk off, and inflation remains high. Fast forward to April 2022, which is actually fairly recent. ERA then told us, oh, look, inflation is high, but it looks like growth is actually turning positive. So even though inflation is high, it looks like people are still spending money. It looks like people are still going out to buy things. It looks like, retailers are actually out there buying, and sales for certain companies look good. So then what that actually essentially meant was that it's probably time for us to take more position in risky assets like equities that can actually give us the growth that our portfolios need. So we actually re-optimize our portfolio to have a higher exposure to equities, and that has really served us well. And performance for our portfolios this year has actually been strong. So this is why it's actually also important to understand the cycles, because in different cycles, as we showed earlier on, different assets actually perform differently. And getting a sense of the different economic cycles, where we're at, where perhaps we're going into, that's also important for you to also make a sound judgment as to where you should actually put your cash, or what are some assets you should actually put your cash into, right? Now, using ERA, we actually built really diversified portfolios. Again, we're going back to the topic of diversified. And this is an example of our SRI 22% portfolio. So it's mid-risk, it's not too high. Just as a little reminder, SRI statutory risk index, what essentially statutory risk index means is depending on the percentage. So as an example here, you see 22%. That means in a given year, there's only a 1% chance that you might lose more than 22%. So for every $1,000, there's only a 1% chance you might lose more than $220. Again, the lose is unrealized unless you actually exit the portfolio, then it's realized, right? But what you see on the app is very different from when you actually click sell. Now, using ERA, again, we built very diversified portfolios. So this is an example. And then depending on your risk tolerance, obviously you pick a level that you feel most comfortable with that will give you very, very different exposure to the different asset classes. And you basically let technology do the rest for you, right? So picking assets, watching the markets, it can all be very time consuming and tedious. So why not let technology do this for you? Ultimately, you are already working hard on a daily basis. Let technology do the work for you and help you make your cash hustle harder than you already are on a daily basis, so that you can actually sleep well at night. So one of the key things is really building a diversified portfolio. That's one thing you want to take away from today, is to really build a diversified portfolio. That's extremely important. And that essentially helps you smoothen out the returns of your portfolios in the long run. Now, one of the hottest topics, and one of the frequent questions that we've been asked about lately from most of our clients actually, is that interest rates are going down, and what should you do with your excess cash, right? So as an example, maybe you have a fixed deposit that's maturing soon. Maybe your bank account isn't giving you good rates now compared to what it was maybe 6 months ago. So to this, we actually answer invest. Now, why? So invest is extremely important for inflation protection. Lower interest rates essentially just means that it's going to erode your purchasing power of cash, because your banks, say as an example, if your account is only giving you 0.5% per annum, inflation is not going up at 0.5%. Inflation is going up way more than that. So it actually erodes your purchasing power. Secondly, it actually, by investing, you actually can grow your cash from the compounding returns that you may actually experience. Second thing, it can actually help you meet your long-term financial goals. The low interest rate environment right now, anything like fixed deposits or bank accounts, unfortunately, your cash will grow, but it doesn't grow as fast as inflation is growing. So it might not actually help you meet your long-term goals, or if anything, it will actually drag on your goals a lot longer. So investing is actually key. At the same time, right now, there are so many market opportunities that can give you higher returns than what FD, again, and standard bank accounts can give you in the next few months. The fifth thing is that uninvested cash, you're really missing out. And the last thing is that it's also important for you to diversify. I think for the last 12, 18 months, it was a very comfortable thing to just hold cash. But the reality is interest rates, we are in a declining interest rate environment. As you can see, the last cut in the US was pretty significant. There's another meeting by the Fed in about a month's time. I think market expectation is another cut. We don't know. But regardless of where the market goes, investing is actually something that you can do today to help protect the value of your cash from eroding further, right? Okay, and with that, we are actually toward the end, but I do want to kind of run through a very quick recap. I know there was a lot of information shared today, but I do want to do a quick recap, and then we can jump into Q&A. I also do not want to keep everyone here for too long. So to very quickly recap, today we touched on why diversifying is important to reduce your overall risk. Second thing, we also talked a little bit about the benefits of asset allocation. It's extremely important for you to have various assets in a portfolio just so that you can balance the risks and steady out the returns in the long run. We talked about how you can actually potentially build a diversified portfolio and the role of different assets, the role of bonds, the role of equities, and within equities itself, there are also differing ranges of risks within equities and different ways, different geographies, different sectors, different large cap, mid cap, small cap. There are also different equities. So we also kind of went through that. The fourth thing is why it's important for you to understand economic cycle. And the last thing is how technology can actually help you with global investing for maximum returns with minimum effort, right? Some action steps that I would highly encourage everyone to do today. First thing, if you want to start investing, if you have not already started investing, or if you are actually invested and you actually feel like you need some refresher, the first thing is to really assess your financial situation, right? Where are your income sources? What is coming in? What are some of your expenses on a monthly basis? Do you have any sort of commitments? How much are you willing to set aside on a monthly basis to what you're investing? These are all very important questions. The second thing is obviously to determine your risk tolerance. How much is a comfortable amount that you're okay to see during market drops, right? So as an example, if you can invest $1,000, and if you were to open the app tomorrow, you'll open your investment account tomorrow, and if you were to see that you're down $100, how does that make you feel? If you feel like, oh, that kind of makes me a little bit jittery, then maybe that's not your ideal portfolio for you. But if, let's say, as an example, you're like, oh, $100, that's still okay. Maybe I can up it to like $12, $15. Then perhaps that's how you understand your risk tolerance. And obviously your investment goal. So that's very important, right? First of all, what is a specific investment goal? Make sure that it's tangible as well. Meaning that it shouldn't just be something where you say that I'm saving up for a holiday, but there's no specific timeline, right? It's fine to be saving up or investing for a holiday, but there needs to be a specific timeline. As an example, if you plan to go to Europe in 2 months, then at least that's very specific. And then you can actually make a goal, or you can actually invest in something that can hopefully be low risk enough. And that come the 2-month mark, you would still have your capital. In addition to that, some additional profit that you had made, perhaps for additional spending money. The third thing is obviously diversify your investment strategy across various asset classes. This is what we've spoken about and why it's very important for you to diversify. Even say as an example within equities, look toward like low risk equities, mid risk equities, and then high risk equities. Don't just put everything into high risk, or don't just put everything into low risk. And just make sure that it matches your risk tolerance. Fourth thing, most important, continue educating yourself on global markets, on trends, on personal finance, on investing basics. Sign up for the remaining 3 Master Your Finances webinar. These are just ways for you to improve yourself and also to improve your knowledge, which is extremely important. Markets are always changing. I think just now in the word cloud, a lot of people saying there are too many different platforms. I get it. It's very important that you also understand the value propositions of different platforms. Stashaway, obviously, this is not the webinar for it, but if you actually would like to learn more, we're available at support@stashaway.com. Fifth thing, most important, if you have not started, the most important thing to do is to just start. Now, it's a lot. I know that it all seems very complex, but the only way to really experience and learn is to do. The next thing you can do is really to start by setting aside a comfortable amount every month. It can be $50, can be $100, can be $150. I think the most important thing is that you set it aside and you don't stop. For a lot of us just now in that little word cloud, there were some people who said that there's not enough capital. Now, even if you had decided that you wanted to commit, say, as an example, $500 every month to a specific investment, but then you realize, hey, this month I have a larger than expected expense. I can't commit the full 500. I can only commit $200. That's fine. The most important thing is that you don't stop, right? And obviously, the reason you don't stop is because through the power of compounding, that's where you actually grow wealth in the long term. And it's also the way to grow like sustainable wealth in the long term, right? So if you see at the bottom, if you were to invest just $1,000 every month for the next 10 years at 6% per annum, now 6% is a really extremely conservative. As an example, the S&P 500 in the last 50 years has given an average of 9 to 10%. So just setting aside $1,000 every month for the next 10 years at 6% per annum, at the end of 10 years, you would have made a total of about $158,000. Bear in mind that your capital was probably about 120,000, right? So $1,000 for 12 months over 10 years, your ultimate capital is 120, and you would have made 158. That means you would have made 38,000 in true compounding returns. And that's actually very, very important. So most important thing is to just start. Once you start, half the battle is already won. So just get over that hurdle first, right? Last thing, we actually do offer also free investing to our clients. So no excuses. It's time for you to start. Even if you're an existing user, if you scan this, you will actually, it will be applied on your portfolio, it will be activated upon your next deposit. If you're new, feel free to use the code MYF 2024. That will actually give it to you. Obviously, if you're comfortable starting, if you need help, we're available at support@stashaway.com. Secondly, as I mentioned, we have 3 more webinars to this series. Next week, we're talking a little bit more about income assets. The week after, we'll talk a little bit more about ETFs. For the last one, the 29, I'll be speaking to Dinesh from the very popular website Dollar and Cents. He's one of the co-founders. We'll be running through some of his personal finance lessons that he's probably learned, and obviously talk a little bit more of his entrepreneurial journey. So if that's something that you'd like to actually be part of, please feel free to sign up. Lastly, before we go, obviously I'll be taking some Q&As, but while we do that, I just kind of want to also get a sense, right? Like from the beginning just now until right now, if the rating of your confidence, has that actually changed, right? So again, if I were to give you now with today, what we've shared today, if I were to give you $10,000 today, how confident would you be in deciding where to invest? Now, has that changed from, individuals who were 1 just now? Has that changed for you? Individuals who were 5, has that changed for you as well? And we also just kind of want to get a sense of, any feedback is also great, right? So we just kind of want to get a sense of whether this was actually helpful for you. So feel free to use the webinar chat function on Zoom. If you're on YouTube, please feel free to use the YouTube chat function. All right, so I'll just give it about another 30 seconds or so. Okay, I'm seeing less ones, so that's a good sign. Okay, so we're seeing varying numbers, and I'm seeing less ones, so that's good. I hope for that after today, everyone else will kind of walk away with a little bit more confidence. What I want to do now is we'll take some Q&A. I see we do have some questions. So let's just go with okay, so let's just go with the first one. Okay, hi. Since gold seems to be doing very well, is it advisable to create a portfolio with just gold? No, thanks for this question. Ultimately, also, it's important for us to create a diversified portfolio. So this really depends on your individual circumstance. This is not financial advice. I do want to caution. But if I were you, what I would do is I would actually create a portfolio with gold and perhaps another commodity just to sort of balance it out a little bit more, because tomorrow gold could not be doing well. It's still volatile, right? Even though it's lower in risk. So I would highly actually encourage you to explore putting it as part of a portfolio rather than just it by itself. I would not encouraged to just create a portfolio with just one asset. I mean, you can if you're absolutely comfortable. But for me personally, I would put it as part of a bigger portfolio because equities are also doing well. So perhaps build an equity portfolio and then have a gold element. I mean, you can try it out on our flex portfolio. So that's actually one way for you to kind of get exposure to gold and just not completely also just kind of having a 100% exposure to commodities, but having it as perhaps a balancing factor toward other asset classes. I think that will be extremely important. All right. What is the differences between emerging markets and emerging markets ESG? Okay. What is the present market outlook on emerging markets? And what is the present market outlook on emerging markets? And what is the market outlook on sectors, areas, types to invest in with highest growth potential in the next few months? Okay. So our investment team would be more they would be more well positioned to answer this. But I can give you what I know at least. So emerging markets and emerging markets ESG are very different in the sense that emerging markets are just basically exposure to the emerging markets. Emerging markets ESG are basically any sort of investment that is, I guess, green or ESG related. So it's quite different. The present market outlook on emerging markets, I think it's basically people are positive about it. But if there are certain sectors or areas or types to invest in that may be highest growth potential, unfortunately, I can't answer that at this point in time. Sorry, I'm not in the best position to answer it. Because this definitely has come from our investment team. But we are actually very bullish on India as an example because of population growth. That's one thing. Secondly, there has been a lot of innovation in India, so we actually have exposure to India in our portfolios. We also recently launched ETFs that give you exposure to Vietnam. So Vietnam, India, those are two emerging markets that we actually really like. And you can actually access these ETFs via our flex portfolio. India is actually one of the ETFs that is in our portfolio in general as well. So in terms of geography, I think India and Vietnam, these are the two geographies that we're bullish on in terms of emerging markets. If you're asking specifically sectors, areas, types, unfortunately, I can't answer that. But this is actually a really good question. So, I mean, Anonymous, if you could actually write into support@stashaway.com, we will actually pass this on to our investment team and we can actually get back to you with more specific answers to your questions. What is the current cycle and where are we heading to? So currently, as per our April 2024 reoptimization, we are still seeing that inflation is high, but growth is there. And also with the cut in interest rates. So generally how markets usually move is that when there's a cut of interest rates, bonds generally perform a little poorer, but equities actually go up. So there's growth. And on that note, our portfolios have actually been well positioned for this since April. So for the last like 5-ish, 6 months. So we actually in April, we actually have our portfolios actually got a bigger exposure to equities, got a bigger exposure to growth assets. So that has also helped our portfolio. So right now, for ERA, what it still tells us is we're still the same. Where we're actually approaching an economy that will still be high in inflation, but actually will have growth in it. So we're still well positioned in that regard. What is your take on the China market? And if we're holding some there, should we reduce it? Again, unfortunately, we can't give investment advice. Right now, I think China markets in the last 2 days have actually performed pretty well. Right now, if you're holding some, unfortunately, I can't give you an answer to that. I wish I could, but I really can't. What I will encourage you to do again is to write into support@stashaway.com, and we will actually pass this answer on to our investment team. And these are actually, all these market related questions are actually really good for us because we would actually write content about this and hopefully be able to share it with everyone in the near future. But for now, the last 2 days has been doing quite well. I think generally with everything, if you're still comfortable with the exposure and if it's still part of your, as I mentioned just now, asset allocation strategy, if you have decided you allocate a certain sum, if that has actually exceeded what you're actually comfortable with in terms of allocation, do think about rebalancing your portfolio. But at this point in time, if you still feel that it has legs, just keep it part of your allocation. But for our view specifically, right now, we don't have that much exposure to China. that's unlikely to change from a stash away portfolio perspective at this point in time, because we do see that there's strength in other emerging markets. But ultimately, at the end of the day, for your own asset allocation strategy, if it's still within the parameters of what you're comfortable with, then you should kind of keep it. But ultimately, also, if you're asking for very specific, at this point in time, we can't answer. But please do write in support@stashaway.com, and our team will actually refer it to our investment team and get back to you. Okay, next one. Why were REITs and Singapore stocks suggested to have growth potential invested with the present rate cuts, but why has the performance of REITs been going down more and more each day for the last 1 week since the rate cuts? Is the financial perspective and advice to wait it out? Would REITs be expected to improve and go up with the forthcoming rate cuts? What's the individual? Okay, so I think for REITs specifically, REITs actually are very slow in growth. So in terms of capital appreciation, if you're looking for capital appreciation, which is what I understand REITs to be, what I understand this question to be, REITs is actually not the right place for you. REITs is really more for dividend. So generally, how it works, right, is you buy REITs, and then whenever this specific company or this real estate investment management company, when they get any sort of rental income, or when they sell a specific asset, then they give you dividends. So REITs are generally more for dividend yield. They're not so much for capital growth. Once in a while, you would see REITs going up maybe 5-10%. But ultimately, I would not actually look at REITs for capital investment. Generally, if for REITs, you will look at it more in terms of the dividend yield, like X percentage per year. I think that's what is most important when it comes to REITs. And what is the pros and cons between investing in an area like REITs via ETFs versus unit trust funds and individual stocks? Okay, so for ETFs, by REITs, it gives you a larger exposure across more sectors. Yeah, that's the word. So you can perhaps get a unified exposure via ETFs to industrial, commercial, residential, all through ETFs itself at a low cost. Unit trust and funds, they also give you broad exposure, but they're actually very expensive. So if you actually have exposure via unit trust or funds, I would encourage you to look at your statements and kind of look at the costs or management fee that you are paying. For individual stocks, you're only getting exposure to very specific sectors. So an example, if you were to buy industrial REIT, then you only have exposure to much of their industrial properties. If you're looking at specifically healthcare REITs, then you're only getting exposure to hospitals. If you're looking at retail REITs, then you're only getting exposure to shopping malls. That's usually how REITs are grouped on an individual basis. Whereas like if you're looking at ETFs, then you tend to get a broader exposure because it basically is all encumbered. It's a much larger exposure in different sectors. Unit trust, again, broad exposure as well, but high cost. Individual stocks is very limited exposure. You're only exposed to a very specific sector at one go. Okay, next. How does investment in US, Singapore, Hong Kong, and China exposure work? Does it work the same as trading stocks? Buying low when it is doing a negative and reverse, and selling when it's green and going upwards, except that the focus is not on the cost of each shares, but the total points of each indexes to be focused on and determine when to buy or sell. Okay, sorry. Let me sort of try to understand. So how does investment in US, Singapore, Hong Kong, China indexes work? Let me answer it part by part, right? Does it work the same as trading of stocks? Buying low and selling when it's in green and going onwards? Yes, generally that would be how investing works. In an ideal world, we want to buy low and sell high. Except that the focus is not on the cost of each share, but the total points of each indexes to be focused on and determine when to buy or sell. I'm assuming this question means how total points of each index. Understand. Okay. So yes, but also when you buy indexes, right, that are listed, there's also a price point to it. So generally, you're also looking at the capital gain and not so much the points. Obviously, when it's a proxy, right, when points go up, the price also goes up. So generally, if you're asking how do you normally trade it, it's the same logic, especially if it's publicly traded and you're buying it on an exchange. It's the same logic as buying shares. Ideally buy low, sell high. So ultimately you're just looking at the index. But there are also, I guess it really depends on what you're buying. So really, it really depends on the type of shares that you're buying. Sometimes you might potentially be buying options, or there are also certain listed options out there that is like a short to the index, where if the index drops, you actually make money. Those are obviously very, very high risk because you're essentially shorting the index. So just be careful what you're looking at and what you're buying. But generally, I think the long short of it, to answer your question, it works the same as buying shares. What is your take on ILPs? So ILPs are investment linked products. Early in the game, I got into one. Should I quit? So I think this question it really depends on your circumstance as well. ILPs, I think the one thing I know about them is that they can be very high in cost. And also it can be also fairly high in risk. Personally, I'm not a fan of ILPs because I feel like if you have the capacity, why don't you just get direct exposure to the market? Because underlying of ILPs are usually like a stock or an index or an ETF anyway, right? That hence investment linked product. I personally, again, depends on your circumstance. If I were you, and if there's no lockup period, because sometimes ILPs have specific lockup periods, so just be careful. And if you want to actually break the lockup period, you pay a penalty. The penalty depends. So if I were you, again, depending on your circumstance, but in my case, I would actually exit the ILP and take a position in an ETF. So as an example, depending on what and also depends on the kind of ILP you have, right? Some ILPs have like strike prices and whatever, and if the share hits a certain price, you get the shares or whatever. So I would actually just buy the underlying myself because at least I have the freedom of liquidity. I have the freedom of dictating when I want to sell. And if I need the cash, I know that I'm not locked up and I don't have to pay a penalty. So yeah, so if I were you, I would actually exit the ILP really and just go directly into the market, especially given now with technology and the kinds of platforms that we have, we all have the capacity to actually invest directly in the market. All right. Okay, since Stashaway utilizes ERA, is it then essentially a robo-advisor or is it an active management of the portfolios? Okay, so robo-advisor was the old term that a lot of platforms used to use. Right now, we are actually a digital wealth management platform. Our portfolios are passively managed. So the last reoptimization we did, reoptimization meaning when we actually swap out certain assets based on what ERA algorithm has told us, was actually in April. And we only do reoptimization. We actually don't do it very often. Reoptimization happens, I think, on average once every, I want to say 12 to 18 months. So it's actually not done very often. So our portfolios are more passively managed. We do have an investment team. Some of you have probably seen webinars with Stephanie, who's our CIO. So we do have an investment team who's there to also, check and balance everything. But ultimately, ERA is there. ERA is there to kind of help us take into account all the economic data and everything. I think a lot of people use the term robo-advisor and digital wealth management interchangeably. So yeah, that's one way to kind of look at it. All right. Next question. Pardon my ignorance. What do you mean by ETF? No, it's fine. It's not ignorant at all. So what do you mean by ETF of country? So, okay, when we talk about ETFs of a specific country, like Japan and India as an example, right? Now, we both know that these markets are doing very well. And then as an investor, then you're then thinking to yourself, okay, then how do I get exposure to these markets, right? Because you might be familiar with the country itself, but you're not familiar with down on the ground industries and companies that are available in the market. So an ETF of a specific country then perhaps takes like the top maybe 10 companies or top 3 sectors in the country, and then creates like a exchange traded fund that basically contains like the top sectors or companies of the specific country. So the ETF in Japan, as an example, I believe the top holdings are financial services. and retail, if I'm not mistaken. Don't quote me on that. But basically, what essentially an ETF of a country does is it helps people get easier access to the country itself. So as an example, if let's say you're bullish on India and you want to get exposure to Indian equities, it's very hard for a person who's outside of India, or a foreigner rather, to actually invest in the Indian market. So that's how the India ETF actually makes it easier, where they actually take like a bunch of companies that are exposed to India, or companies that are domiciled in India, and then they create these exchange traded funds, and they just call it like an India market exchange traded fund. And essentially, you as an investor, by buying into the ETF, you get exposure to, let's say, the top 10 or top 20, top 50 maybe companies in the country, where then it works as a proxy, whereby then it gives you exposure to the country itself. So I hope that actually answers your question. Next question by Rudy. Is the free fee waiver not applicable for existing customers? It should be. MYF 2024. Otherwise, if you actually can't, just try scanning this again. It should be applicable. If it can't, Rudy, could you write into support@stashaway.com? We will actually place an equivalent onto your portfolio for you. But it should actually be entitled for existing customers. Okay, so we are short on time, so let's stop at 8:15. So I'll take a few more questions and then we'll stop at 8:15, because I also do not want to hold people for too long. Are there any new portfolios that are in the making and maybe introduced within the near future? Could you share some details about the assets that will be involved in the sectors that will be focused on, more details on the portfolio and risk? I'm assuming risk structure. Thanks. Okay, so we recently just launched an income investing portfolio. That basically gives people, this was actually done in partnership with JP Morgan. So we got actually some bond funds from JP Morgan, and they helped us build this income investing portfolio. It's Singapore hedge. That means you won't actually have any foreign currency risk. You're not actually taking on any sort of foreign currency risk. So that is currently the newest portfolio that we have. In the future, I mean, if you have any sort of suggestions, we'd be more than happy to actually also hear from you. At this point in time, given that income investing is one of our newest portfolio, I think our focus is really on now refining the portfolios that we currently have. So we have anywhere from core portfolios to thematics right now to bond exposure, and then we also have flex. So we really want to ensure that we actually, with whatever existing portfolios we have, we actually do it well. So if we do have any new portfolios that are upcoming, you'll definitely be hearing from it. But right now, we actually just launched income investing portfolios. Again, that has exposure to bonds. That's actually doing pretty well. So you can actually find that on the app itself. If you're based in Singapore, if you're on the Singapore platform, that's currently available to you as a user. All right, let's take a few more. So I invested in REITs unit trust due to the speculation of the rate cuts that happened, but it does not seem to have a dividend payout option. And the capital has been down to 5% in just 1 week and days. What would your advice be, and what would you do in this situation? Okay, so for the REITs unit trust, I think payout option is best you check with your fund manager when the payouts happen. Unfortunately, I guess it really differs from fund manager to fund manager, and also depends on the underlying. So I can't give you a direct answer for that. Capital has been down to 5% in just 1 week and days. So I would first say, again, not advice, but what I would perhaps do if I was in your situation is, first of all, I'll find out from my fund manager, whoever this fund manager is, or unit trust agent, about what the payout option usually is. Is there even a payout option? How do the fund do? Does it automatically get reinvested? Does it come into my bank account? I think those are key things for you to understand. The second thing is, if you feel like you can take higher risk, then which I generally, I'm not I'm not a big investor into funds, because I personally, I'm still at a stage in life where I can take higher risk and I understand the risk that I'm getting myself into. I would just put my money into ETFs, to be honest. And at the same time, the fee is a big thing, especially for unit trust. So just make sure that you also take into account the fee and the opportunity cost of the cash that you're using to pay the fee, which can also be invested elsewhere to make you perhaps bigger compounding returns. So I think that's something that you should definitely take into account for yourself. I hope this helps, really. If you want very more specific guidance or consultation, or if you do want to talk to someone who can perhaps understand your situation a little better, please feel free again to reach out to support@stashaway.com. Our client engagement team is available, and we'll be more than happy to sort of kind of walk you through the thought process in terms of how to make a decision. All right, let's take one last one. How to determine if management fee is reasonable when reviewing UT? Any formulas? No, unfortunately, there's no formula. I think it's really just, okay, so you have to think of it this way, right? So as the earlier question from attendee before was that they are invested in REITs unit trusts, and currently they're down 5%. So look at your fees, right? That means if let's say your fees are 2%, unit trust funds, usually it's like they have a fee, and then every time you put in more cash, there's a transaction fee. If you were to sell, there's an exit fee. So there's entry fee, exit fee, admin fee, management fee. Every couple of years, they charge you some fee. So kind of add up those fees. I'm not sure how much you'll come up to, but it'll definitely be slightly more than 2%, maybe sometimes touching 3%. And that actually kind of eats into your gains, right? Because if you make, say, for example, 5%, which sounds great in the grand scheme of things, but then if you're paying on a yearly basis 2%, that means that you're only making 3%. Can you get more than 3% somewhere else? Just kind of think about that, right? So it's there's no formula. It's really just sort of understanding where it is. I mean, if it's a unit trust that's giving you 20% returns, 30% returns, and you're paying a 2% fee, maybe it's reasonable, but you can still get lower cost options somewhere else. But generally, if it's a low risk unit trust fund, and you're paying anywhere from 2 to 3% a year, and you're only making 5%, 4%, when you net it off, like your net returns is actually very, very low. It's equivalent to perhaps just keeping cash in a bank account, right? Almost. Then perhaps you should then rethink your strategy, and whether or not it's even worthwhile investing in these sort of funds. That's why for Stashaway, our funds are super transparent. It's very low as well. It's 0.2 to 0.8 per annum. Obviously, the higher the AUM, the lower the fee. And as we shared, some of our portfolios are already touching 10%. Some of our lower risk portfolios are touching 10%. So on net on an average yearly basis, you're actually making, more than 8 to 9%, which is already a lot better than a unit trust. So there's no formula, but I think it's really just understanding what you're paying and also what the fund is making, and then doing that simple math to really see if it's even worth it, right? Because the additional fees that you're paying, if you could have exposed yourself to something a little bit more lower in cost, the additional fees can actually go toward investing, and actually the growth from that fee can actually compound into a lot more in the future. So yeah, just kind of having that mindset, I think is extremely important. Okay, I think we should call it an evening. I do see a few more questions. I would highly encourage everyone to actually write into support at stashaway.com if you have any more questions. At the same time, with whatever we have here today, we will definitely take it back. If need to, we will actually, try our best to answer these questions in a more public forum, because I think these are actually really good questions, especially about the fees and, engagement on our part to our clients. If you're not a client already, that's okay. Feel free to reach out to us at support@stashaway.com. We'll be more than happy to answer any questions that you may have, not just about Stashaway, but about markets in general, about your financial circumstance. If you need help understanding certain personal finance or investing jargons, we're more than happy to help as well. And yeah, once again, thank you so much for joining me this evening. If you want to sign up for the remaining 3 webinars, it's still not too late. If you found this helpful, please do share this with a friend. Ultimately, our goal is to really help people really understand why it's important to not only invest, but also invest in sustainable options. And why, there are ways for you to build long-term goals, and obviously to demystify the myth that you need a lot of money to make a lot of money. You don't. You just need the right tools, the right knowledge, and the last thing you really need is also the perseverance and to have that consistency. So with that, thank you so much again. And hopefully I will see you next week. Good night, everyone.